Pricing, lots, pips, spread. In the stock market, we buy individual shares, but in the FX markets, we trade specific amounts called lots. Originally, the smallest trade size we could make was one lot. If you were buying one lot of the Euro-US dollar pair, you would be selling X amount of US dollar to buy 100,000 euro. This is obviously a fairly large trade, and you would need a large trading account to trade this amount, if you were using some sort of decent risk management. Because most traders start out with relatively small accounts, 50,000, 10,000, even 1,000 or less, most brokers now offer smaller lot sizes. This enables these smaller accounts to trade and manage their risk a lot better. The four main lot sizes you can now trade are 1. Lot, standard lot, 100,000 units of the base currency. 2. Mini lot, 10,000 units of the base currency. 3. Micro lot, 1,000 units of the base currency. 4. Nano lot, 100 units of the base currency. Note, not all brokers will offer all of these lot sizes. Some may just offer standard and mini lots, so keep this in mind when you are looking at different brokers to work with. Also, many brokers that offer micro or nano lots trade against you. More on this in the broker section. Pips. PIP in Forex stands for point in percentage. PIP is simply used as an easy way to express a price movement in a Forex spot pair. If you were looking at the Euro-US dollar pair and the price is 1.1816 and then moved up to 1.1823, you would not normally describe this increase by saying the pair is increased by 0.0007 cents. You would simply say that it is increased by 7 pips. That is a lot easier to say and understand. So how do we know what a pip is? For all currency pairs involving the Japanese yen, 1 pip is calculated from the second decimal place, 0.00. On the USD Japanese yen, a move from 112.43 to 112.48 would be a 5 pip increase. For all other currency pairs, 1 pip is calculated from the fourth decimal place, 0.0000. On the Euro-US dollar, a move from 1.1816 to 1.1819 would be a 3 pip increase. The main reason the yen is different is because they have no dollars. They really just deal in cents. In the US, like most other countries, they have dollars and cents, but in Japan they just have yen. So if the US has no dollars and just use cents, it'd be similar. $1.25 would be 125 US cents. Pipette. As the Forex markets have developed over the years and technology has increased, you will now see most Forex pairs quoted to 5 decimal places, or 3 decimal places for the yen-based pairs. This does not affect what a pip is. This just means we can now easily speak in fractions of a pip. This fraction of a pip is now commonly referred to as a pipette. If you bought the Euro-USD at 1.18166 and later sold it at 1.18197, you could say you made a profit of 6.1 pips. Or 6 1/10 pips, or 6 pips and 1 pipette, or 61 pipettes. Personally, I would just say 6.1 pips. If you bought the US dollar Japanese yen at 112.460 and later sold it at 112.494, you could say you made a profit of 3.4 pips, or 3 4/10 pips, or 3 pips and 4 pipettes, or 34 pipettes. Again, I would just say 3.4 pips, but all of the above are saying the same thing, so up to you. 6 of one, half a dozen of another. Pip values. Okay, so let's say you did make a 6 pip profit. What does that really mean? How much did you actually make? What is 1 pip actually worth? To work this out, you need to make one of the 2 following calculations. If your account currency is the same as the quote currency, pip value equals position size times 1 pip. 10,000 times 0.0001 equals $1. Pip value equals $1. So if your account currency is in US dollars, then you would use this calculation for any pair that has the US dollar as the quote currency. For example, Euro US dollar, Australian dollar, US dollar, New Zealand dollar, US dollar, British pound, US dollar, etc. If your account currency is not the same as the quote currency, you need to add another step. Pip value equals position size times 1 pip divided by conversion pair price. 10,000 times 0.0001 divided by 1.3854 equals 72 cents. Pip value equals 0.72. The conversion pair price is the exchange rate of the quote currency and account currency. So if your account currency is in US dollars, then you would use this calculation for any pair that does not have the US dollar as the quote currency. For example, US dollar, Japanese yen, euro, British pound, Australian dollar, Japanese yen, New Zealand dollar, Swiss franc, etc. Let's look at the New Zealand dollar Swiss franc pair as an example. Say you made 14 pips profit trading 2 mini lots in your US dollar based account. How much US dollars did you actually make? New Zealand dollar Swiss franc equals 0.69771. Although this is the pair that we want the pip price on, we do not need this figure. US dollar Swiss franc 0.97079. Our formula is position size times 1 pip divided by conversion pair price equals the pip value. 20,000 times 0.0001 divided by 0.97079 equals $2.06. So if you made 14 pips, then you would simply multiply 14 by $2.06, giving you a total profit of $28.84. And if all of this is too tiring or confusing, then simply log on to your GLS Equity back office and use your calculator. Easy as pie. We use the calculators. The only reason we added these examples in this course is so that if you have to work it out manually, then you can. Spread. Most FX brokers do not charge a commission to let you trade with them. So does that mean these brokers are really just nice people that honestly want you to succeed? Well, not exactly. What they do is simply widen the spread and pocket the difference and hope no one notices. It may sound a little dodgy, and I guess it kind of is, but it's been done for so many years now that it is just common practice. The spread is simply the difference between the bid and ask prices. When you look at the market price of any asset, you normally see two prices, the bid and the ask. The bid price is the highest price someone is willing to pay for this item, and the ask price is the lowest price someone is willing to accept for selling this item. When you place a simple market order to buy, you will buy at the ask price, the lowest price someone is willing to sell the item to you. When you place a simple market order to sell, you will sell at the bid price, the highest price someone is willing to pay to buy the item from you. If you told your broker or placed an order online to buy one lot of the euro US dollar and then sell it straight away before the price even moved, you would lose money, even if the market did not move. This is because of the spread. Right now, looking at my chart, I see the following two prices for the New Zealand dollar US dollar pair. If we subtract the bid from the ask, we're left with the spread. In this case, it equals 0.6 pips. Ask 0.71052 minus bid 0.71046 equals 0.00006. On one standard lot, this would have cost us $6, as you would have just learned from the previous section. So back to our good old broker. Not all of this spread is their profit. There is always a spread, as we discussed in the market structure section earlier on. If there was no spread at all, then it would mean that all current buyers and all sellers wanted to transact at the same price, and in the online trading world, this would happen in just a few seconds, and then there would be no market, no buyers or sellers left, except for new players continually coming into the market. So let's say the actual interbank spread is 0.4 pips. Your broker can simply widen this and offer it to you as 1.1 pips. This way, every time you trade, your broker will make 0.7 pips from you. This is their commission, even though they like to say they don't charge a commission. When you open and close a position, you pay the spread,